So core inflation showing signs of easing in Canada, and we did get a slight pickup in the headline number in the latest month, but it was less than expected. We're joined by Lesley Marks, Chief Investment Officer at Mackenzie Investments. Lesley, great to see you as ever.
Good morning, Andy.
So apparently this will cement or make it more likely the Bank of Canada will cut tomorrow.
Well, I think that it's really a benign inflation report. And for all intents and purposes, to your point, it will support the bank's decision to cut interest rates, the Bank of Canada's decision to cut interest rates by 25 basis points tomorrow.
And what about your accounts, your clients? What are they saying? Are they paying a lot of attention to what the Bank of Canada is doing right now?
Well, I think that all Canadians are paying attention to the Bank of Canada, certainly, although they may be more focused on the Federal Reserve. But for Canadians, the Bank of Canada is important because it impacts financing rates for any Canadians that have any type of lending or debt, as well as the most important, which is mortgage rates and the impact on the cost to mortgage your house, which is typically the biggest expense for most Canadians. So the Canadian Main Street consumer is definitely paying attention to the Bank of Canada. The Canadian investor, though, might be more focused on the Federal Reserve.
Yeah, I've heard that on Bay Street and among investors, the Fed is the big driver. I'm trying this tech rally. What are you telling clients about it? Just ride it or take profits?
Well, I think a lot of ink has been spilled about the expensiveness of technology, about the limited drivers for the S&P 500, the concentration. And, while all of that may be true, the reality is, and I think most investors recognize, that the earnings growth and the cash flow growth coming out of these large cap tech stocks is disproportionate compared to what it has been historically. So that has really justified or rationalized that rally in tech stocks. So we're not saying that the setup with tech stocks is making the market dangerous, like some people may be. We think it's actually well supported by fundamentals, but we are continuing to encourage investors to think about diversification. And actually, interestingly, the TSX is up more than the S&P 500 year to date, despite the fact we don't have that big technology exposure.
Yes, after quite a few years of underperformance, but you're dead right. We have been beating. I guess the golds have been a big help there.
The golds are the story in Canada. I mean, of course, our technology shares have been doing well, but they're not a big enough weight to make the difference here. And so this has really been a gold story. So for investors looking to diversify their risk away from those heavily weighted technology shares in the S&P 500, the TSX actually makes a very good opportunity for them because it does give you that exposure to hard assets like gold shares, which do very well in this market environment.
Is there an area of the market you think investors have been neglecting? I know it's hard to find it maybe with stocks at record highs.
Well, I think there's a couple of areas. For one, I do think that, globally, Canada represents such a small portion of global investing, so it's likely underowned by global investors, which makes sense. I think another area that investors have not had to focus on is other areas of the market outside of those top 10 holdings in the S&P. So I think that's where there's opportunity, where people aren't as focused on small and mid-cap companies in the U.S., where there may be potential to see some earnings momentum if the U.S. economy can hold in here. And recently, over the last few weeks of trading, we've actually seen a good move in smaller names, which is actually quite healthy. You're starting to see a broadening out across the market, which I think would make people feel a lot more comfortable than just seeing the same old in the top performers.
Yeah, is there, I'm not sure how much you track this, but there's always an obsession among some retail investors for yield. And people like a security that pays them a yield, even though I guess you could just liquidate 4% of your portfolio each year and generate income that way.
Certainly, Canadian investors have shown a propensity towards yield. And I think a big part of that is because the TSX actually pays a higher yield. The banks represent a bigger portion of our market, or financial services, which tend to be higher yielding than in the United States. So yield tends to be important for investors, I would say, outside of the United States. Even in European markets, we generally see higher dividend yield in those indices as well. They're more value-oriented. Unfortunately, yield or dividend yield has been a factor that has been very out of favor globally when it comes to investing. The factors that have been very much in favor have been large cap, earnings per share momentum, and 3-month price momentum. And so dividend yield kind of falls to the bottom, but that doesn't mean that there isn't opportunity there. It's just that it's not an area that the market is preferring right now.
3 months price momentum is a thing in vogue right now?
Well, it's one of the top performing factors when you look at market performance and what the market is rewarding.
What are you telling clients about energy and oil?
Well, energy and oil is really a tough one. You have two competing trends here. One is the trend, away from or towards renewables that we're seeing globally, despite the fact that there may be less interest here in North America. In very large markets like China, EVs are dominating the market. So the idea of long-term growing demand for oil is a question mark. On the other hand, oil also is quite economically sensitive, and the economy seems to be holding in here very well. Yes, of course, there are some signs with weaker labor, but overall, from a global GDP perspective, economic growth around the world is fairly benign, quite good. And so that's actually good for demand for oil. So oil has, and energy hasn't been a huge focus for investors. There hasn't been a reason to be. And I think gold has really stolen the spotlight for the resource investor. But I come back to that diversification piece and that, you want to make sure that you have diversified exposure. In the event that there is a move higher in energy that could be related to geopolitical risk, for example.
Lesley, thanks very much indeed. Lesley Marks, Chief Investment Officer at Mackenzie Investments.